ahead of the Thanksgiving Day holiday, the Dow has hit a new intraday high. This week has been a milestone for the major equity averages. So joining me now is Keith Bliss of Cuttone Co. Keith, thanks for joining me today.
Thanks, Remy. Good to be with you as always.
Well, of course, all over the country, many people are thinking about what they're having for Thanksgiving dinner as well as football. But here on Wall Street, we got quite a feast of economic data releases, and we still had those Fed minutes. So what do you make of the levels we've been seeing this week?
Well, listen, the levels that we see inside of the markets across all the major indexes, it really is broken field running right now, if I can borrow a football metaphor, given where we are in the calendar. And when you take a look at how they have broken out from a pretty narrowing range that we were in right before the election at the end of October, we're now well above those. And the next stop in the indexes, from what I see, is a trend line which goes all the way back to 2011. We've still got a lot of room to maneuver there. We could see the Dow, if we were to go up and challenge those, we could see the Dow trade all the way back up to 19,600, 19,650 before it met some pretty stiff resistance. And then if it breaks out of there, 20,000 is absolutely within the cards, no doubt about it. And that's my call. I think that's where we're going to get. Same with the S&P 500, obviously not to 20,000, but it will continue to set new all-time highs. The Russell is also the index that is really the most important right now, because that is the index that is reflecting and both reflexively trading according to what Trump's policies could be once he assumes office.
And of course, we have the Fed meeting coming up in December, so all eyes will be on that. But given the latest economic data releases as well as Fed fund futures, a hike is pretty much a priced in, and we continue to see the U.S. currency surge on expectations as well. But do you think traders as well as investors need to be wary of what we're seeing overall?
No, I don't think so. Again, from the averages, technicals always reflect everything. If you believe in technicals, they always reflect. They're the amalgamation of everything that's impacting the market, whether it's emotion, fundamentals, company earnings, you name it. The economic data, the slew of data that we got today, and everything was compressed because of the short week, are really pointing towards stronger growth, or at least that's the expectation. So, for example, the durable goods orders were a blowout number. Today. Consumer expectations on inflation was much higher today. New home sales was a little bit weaker, but only because roughly 270,000 new homes came on the market. We're still have an 18% uptick year on year where we are. So, and the dollar, the currency trades are generally pretty smart in predicting where we see interest rates, Fed policy moves, Fed monetary policy moves. I don't think consumers should be worried right now. Now, one thing that we'll have to think about looking forward a month or so, more than a month or so away, is when we start getting fourth quarter earnings reports in January, and we'll have to see how all companies, small and large, are talking about the impact of the dollar moving higher. I think, again, from a technical standpoint, the dollar will move higher. Given what everybody thinks about inflation, parity with the euro is probably in the cards at this point. I wouldn't be nervous right now. I'd ride this wave.
And Keith, last but not least, it's always a treat to have you on since you watch some interesting indicators. What are you seeing right now?
Well, again, I'll harken back to the Russell, and the other one that I'll look at is the NASDAQ. Right now, I would still say that all markets, all indexes are overbought. I'd expect a modest pullback. But as long as the NASDAQ stays well above the 5133 level, which for years acted as a firm level of resistance. 5133, by the way, was the pre-bubble high going all the way back to 2000. So I looked that long in the time frame. The Russell also is another indicator. It's broken out to new highs. There's nothing to stop it in its path. And again, the Russell is the most reflective of U.S. economy, policies that Trump will do to influence U.S. policy. And the last indicator in kind of combination pattern I look at is the dollar-euro. Right now we have very much an overbought dollar, very much an oversold euro. That's typically weak for U.S. equities. So again, I would expect this run to at least pause a little bit. I don't expect it to pull back, but given where we are with that pattern in particular, don't expect it to be a straight line like it's been the last week, but we'll get a pause. We'll reallocate some money, and then I think we move higher into the end of the year.
Okay, Keith, pleasure having you on as always, and have a happy Thanksgiving.